call it steeper trend line. Whenever the market started going to a steeper trend line, it says that it's no longer coming to tap that trend line. You know that the trend is strong, very, very strong. And if you don't, if you're not careful, if you touch the trend line on the one you want to enter without waiting for confirmation, the next thing you will see is a fast breakdown. So as you can see, the market came to this point, created another one here, tapped here before, but this is trend line support. The other one is trend line resistance. Please make sure you understand this thing, so that you don't go to lose money anyhow. No, you don't go the blue account. Okay, the next one is moving average. Okay, let me bring out my moving average. Moving average support and resistance. MA moving average. Okay, yeah. Now watch. Because the market is in a downtrend, look at what is actually happening here is that the trend line was actually acting as support and resistance. Now watch. Look at here. It taps here, telling you that here is a resistance. It taps here, telling you that here is a resistance. This is what we call trend line resistance. Now for the support, simple. Based on what I showed you earlier, see the way the market was actually tapping on that my trend line, but now it is now acting as support using the moving average. Using the moving average, hope you're seeing it. It's just tapping and tapping and tapping. This is moving average support and resistance. So my guys, this is what you need to know. I just decided to throw out this rich write-up so that I won't forget anything. Now let's go into how to take your trades on support and resistance. We have conservative entry and aggressive entry. Conservative entry and uh, aggressive. Okay, now let's look at two of them. Let's look at two of them. If you can be able to understand everything I teach here today, bro, support and resistance will turn to a breeze. I am telling you. If you can be able to implement all these things, support and resistance will be a breeze. Please try and practice immediately after this class. He who learn and don't implement is more like someone who doesn't even learn at all. So make sure you implement, please. Okay, now we're going to go into entry. How to trade entries on support and resistance. Now, let me still use that volatility 25 index. Now, if you watch carefully, this is one day time frame. This is a zone that the market has been testing. The market came here, created a support, a strong support. It was a resistance, but now it's now a support. Now the market has bounced there and is now bouncing out from it. Let me step down to 1 hour time frame, for example, so that we'll see the proper reaction of our entry candles. Are you seeing what is happening? On 1 hour time frame, the market created a double bottom. I should have traded this thing. Just saying it now. Should have entered earlier. Okay, the market actually created a double bottom on this zone, and now it is bouncing out of it. So you as a trader, I have seen traders trying to once you see this candle, first candle, they'll get their stop loss, their listing, their stop loss below here, take profit somewhere around here. And the next thing you will see, the market will just, go up a little like this. Boom, it will come down and take out their stop loss. Immediately you see it take out that stop loss, you see it start going up again. I will be like, this shit doesn't work. It's called market manipulation. You don't trade on support. You don't trade on resistance. You trade the bounce. This is what I mean by bounce. Okay, this entry now, based on this entry, this entry here now is what I call aggressive entry. This is aggressive entry. Now, what is conservative entry? You have seen this market has bounced out. It has created the first candle. Meanwhile, I don't actually trade on lower time frames. I trade only on 4 hours and 1 hour times. 4 hours is my entry this thing. time frame, but most times I trade on 1 hour too. Depends. So, and another thing, always wait for close of candlestick. Like let's use for 4 hours for example. Let me show you what I mean by the closing of gold. Now, if you watch this market on 4 hours time frame, the market came to this point. It created, it bounced out from this place. Immediately it bounced out on 4 hours time frame. Aggressive traders who trade this in this way. This is in this way. Aggressive traders will trade like so. Now, but a conservative trader will wait for this. This is more like a consolidation. Here, a whole of this place is consolidation. A whole of here is consolidation. So, what do you do when you see a consolidation? You only wait for that consolidation to break. Zone. You only wait for the market to break that zone. Then you enter. Now, in as much as here is a big range, you wait for the break. Now, since I've seen that the market came up with a 4 hours candle, tapped the highs of that rectangle, that my zone, I will just step down to 1 hour time frame and wait for a break, a proper break of that zone, which is look at this candle, look at this small candle here. This is a proper break of it. This is a proper break. These two candles are proper break of this zone, telling me this is a confirmation for me to enter. So me as a conservative trader, I will just bring my trade here on the close of this 1 hour candle. You see how my stop loss is wide? Yes, this is how your trade should be for you, so that your emotion will not be played. Okay, when you enter, you know how much you're risking. Like for example, if I'm entering this volatility 25 and I am using like all these one lot, those lots doesn't work on volatility, but you know understand what I mean. If I'm entering based on risking 24 pips, if I'm risking 24 pips, I should be looking at making, because this market is actually going to come into this place. So this is a trade of 2:1. If I am risking $24, I am expecting to make at least 48 dollars. That is simple as that. If I'm risking $24, I am expected to make at least $48. That is two times two of what I risk. So me, if I am actually trading this pair, I would enter here on the break of this consolidation that happened there. Though it's a double bottom, this consolidation, then my take profit will be, you know, make it realistic. Don't go and start drawing it from there to Japanese. It will not work. Make it realistic. You bring it here because there is a kind of resistance somewhere around here. You bring it here. Now your first take profit will be here on this zone, because there is a candle formation of candle there. That is your first take profit. This
Hello,
market
can you
can
hear me, sir?
actually come,
Can you hear me?
from as it's pumping now,
Can you
it
hear
can
me,
actually
please?
come here and start coming down again. So because you know
Sir, they,
you
they
are
can't hear you.
realistic
Can you hear
with
me?
your entries and exits, you should know that you should secure some profit when the market gets to this zone. Simple and short. What do I mean by securing some profits? You move your trade. For me, I don't trade on break even. What I do is, when if I'm using two lots to enter a trade, and the trade goes to my first take profit, the simplest
Can
thing
you hear
I
me,
do is
sir?
I close one lot. I close one lot, leaving one lot open. Now that one lot that I am leaving open, I'll move my stop loss. Since my stop loss is here, I'll just move it from here to somewhere around here, bring it up to this point. Meaning that even if the market reverses against me, it will not hit my stop loss. It actually hits a break even, and I am still in profit. But if it eventually breaks out from that first take profit and begin to go to the upside, it's another advantage to me. That is the best way to trade. Stop being greedy, trying to flip $10 to $50, $100 in a day. Stop being greedy. Be realistic with your trading. That's the best way to make money from this market. If you are greedy, you keep on blowing and blowing and blowing. You're actually giving professional traders like us your but anyway, there will be liquidity in the market for the market to move. But please stop blowing your account. Wait, always have patience, please. So I've shown you conservative trading, aggressive trading, support and resistance, everything you need to know about it and all that. Is there any other thing remaining? Okay, how to place stop loss. I think I've shown you guys that if you're entering like so, I've seen I always see people place their okay. I always see people sorry coming. I always see people enter trade like so and now what is happening now? Okay, I always see people enter a trade like so and now bring their stop loss somewhere around here. If they whine me, if they whine me, this thing will break. If this thing can actually reverse, hit your stop loss, push you out from the market, and begin to go to the dire direction again. Your stop loss should come below the swing low, like so. It should come below the swing low. That is how you should enter the market with your stop loss. You don't just place your entry and carry your stop loss and come and put it. Uh-uh. If you're not willing to lose in this market, you don't even need to come close to it. So if you want to trade, you have to make sure that you protect yourself in all angles. So in order to avoid market manipulation or hit stop loss and go to that direction, just if you place this trade like this, for example, if you place this trade like this, and eventually the market comes down, hit your stop loss, it doesn't mean that your analysis is not correct. It simply means that the sellers in the market are bigger than the buyers in the market because the buyers are not yet strong in the market. That is the psychology. When you are good with your technical analysis, your risk managers, and your psychology, when you lose a trade, you should know that it is not from your strategy. It simply means that if you were expecting a buy, it simply means that the sellers are in the market are more than the buyers in the market. So you now reanalyze to know the reason why what happened. You know the reason why your trade hits a stop loss. If it was from your own angle, you take correction. Always try to journal your trades. If you enter a trade and win, you write it down. If you enter a trade and lose, you also write it down so that you know the reason why you lost in that trade and take correction so that it will not happen again. That is how to trade. I think I have explained everything I need to talk about on support and resistance. So I I'm going to I'm going to take questions from here. So if there is anybody that have question, please you can ask your question. The floor is open. Thank you.
All right, sir. Can you hear me, sir? Can you hear me, sir? Hello, can you hear me? Can you hear me, sir?
Hello.
Can you hear me?
If you have question, raise your hand, please. I can actually unmute if I have the opportunity. If you have question, please raise your hand.
Mohammed, can you hear me? Go ahead and ask your question. Mohammed, can you hear? Are you here?
Oh, guys, sorry, I can't open it. Oh, Mr. Gerard, spare. I can't unlock you. The okay, okay, you can speak.
Good evening.
Good evening, sir.
Please, when you were talking, I think your mic was somehow breaking. We could not hear you at that. We could not hear you.
Okay, so which part?
Okay, when you were talking about the where to place the stop.
Okay, let me go through it again. Let me go through it again. Now, watch. Let's say this trade is a buy. As you are looking at it now, it's a buy. And I am very certain that this market will come to this point as first take profit. Okay, this is your first take profit before you start looking at this side or here. It will come there, react a little bit before coming here. But if eventually the market doesn't get to this high, if it doesn't get to this high, because there is a resistance here, if you watch, look at it, there's a resistance here. If the market doesn't get to this high, it may come to this one, this first take profit, and reverse again to come and test this neckline, because here is a neckline. You come and break it later. Here is a neckline. If you go and study your double bottom, all this chart pattern, you will understand that here is a neckline where the market need to respect. You can actually, as it's pumping here, bounce here before taking off to this one. That is the simple thing that will happen in this trade. Okay. Most times it will not come down to come and test this neckline, or it will just start flying up to the upside. It depends based on the type of buyers in the market, the quality buyers in the market. Now, for that stop loss, if you're actually entering the, let's say you entered this trade from here for aggressive traders, don't come and place your stop loss here. People make this kind of mistake every time, and market manipulation will always catch up with you. You can actually place this trade. Yeah, okay. Some people who place this kind of stop loss, they are lucky today because the market started going up immediately because it's a double bottom. It flew out immediately, and there is a situation whereby you place it this way, the market will just come down again, hit a stop loss, and still go back to where it should have gone to. And you are no longer in the market. You are now crying because you have lost money. Okay, the best way to place stop loss is just bring it below that swing low. If it is on a resistance, let's say you want to enter this trade from here. For example, the market came here, broke down. Now you are entering this market from here. Your stop loss will come above the swing high, and your take profit will become a swing low, like so. This is how to trade. Let me remove this zone so that you understand. This is the best way to trade it. Not bringing your stop loss here, because you enter there and you're expecting the market will hit you out and still go to your direction. So the best way to trade is place your stop loss above the swing high. Place your stop loss on the buy below the swing low. This is the best way to trade. Thank you. Any other question? Mr. Charles Opera, sir, please can you unmute Mr. Charles Opera? Hello, admin, sir. Okay, it seems I'm hearing somebody's voice. Hello, Mr. Gerard.
You can.
Hello, Mr. Gerard. Who is speaking? Mr. Gerard.
Afon.
Okay,
Yes, this is Gerald. Can you hear me?
I'm hearing you, sir.
Okay,
I
good
hope
evening.
I hope you have understand how to play stop loss, right?
Yes. I understood everything.
All right.
But, this pair, this step index, is there a different way to calculate that the step index? Because that step index, even the smallest place you want to put your stop loss, you will see that is a huge amount of money you are risking.
Okay. I understand. When it comes to synthetic, hello. When it comes to synthetic, there
I'll
are
need
pairs with high volatility. When it comes to synthetic, there are pairs with high volatility.
info on entry points.
Hello,
I need to
who is speaking? Please, now let me answer Mr. Gerard first, please. When it comes to synthetic,
know.
there
I
are
need more
pairs.
info on entry points. I need more info on entry points.
I've heard you. Who is speaking? I've heard you. Just calm down. Let me finish answering Mr. Gerard. When it comes to synthetic, there are pairs that have high volatility. Example are volatility 50 index, volatility 25 index, volatility 100 index, step index, volatility 75 index. These pairs high volatility. If you are trying to trade this pair, you will have at least $50 and above. You will have at least $50 above, because most times your trade might be on the right side, but because you don't have enough money to hold that trade based on the drawdown before it starts to go to your direction, you will be kicked out from the market and the market will still go to your direction. So to avoid this thing, you should have at least $50 and above before you start you start trading all these high volatility pairs. Remember, 25 second, 25 1 second, 75 1 second, 50 1 second, volatility 100 1 second, 75 1 second, and step index. These are high volatility pairs on synthetic. I believe that you. Is there anybody, any other person who have questions? Mr. Jared, did you understand it?
Yes, you actually answered it. So,
All right. Is there any other person?
Yeah, somebody was asking about the entry points just now.
Entry points. Okay. I explained two types of entry points: aggressive and conservative. Easy and straightforward.
I'm
But
on
this entry here now, this entry like so, is an aggressive entry. This entry now, as you're seeing it, is an aggressive entry. Most times you will be lucky and the market will not reverse back before going to the upside. That is it. But me, I'm more of a conservative trader. In as much as I have seen this consolidation happening in between this double bottom, the consolidation, I will just use a box, simple and short. No need of stressing myself. I will just use a box and close it. And I'll tell myself, but I will write on my trading plan for this trade. I'll write it there. Emmanuel, if this market doesn't play out of this, if it doesn't go out of this box, don't trade. And I will stick to it. I will be patient, waiting for this trade to happen. Immediately, the market breaks out from this ranging market. Trade that first candle that broke out. I'll just enter here, somewhere around here. That's me for you. This is my stop loss, 25 pips. And I'll be looking out to make all these pips because I know the direction of the market. When you know the direction of the market using top-down analysis, everything becomes a bit. I can actually trade this market to this point, and I will hold it for like 1 week. I'll just click the buy button, and I will leave the trade for like 1 week. No emotions. I know how much I'm this. I know how much I'll make. I can imagine risking 25 pips to make 78 pips. I'll click the buy button, forget about the trade, close my laptop, close my phone, and forget about this trade to play out. What I will now do is just to monitor it after a day. Every day I will go and monitor it to see what is happening. So, it is one thing to place a trade, it is another thing to allow your trade to play out. Many of you are so quick. Scalpers, you jump into the market, 5 minutes you're out. You jump into the market, 5 minutes you're out. With that kind of jumping in and jumping out, you won't make a good money from the market. I am telling you, because when you jump in, you make profit now. You jump out, you jump in again, you lose that profit you make. You jump in again, you lose your capital. But when you enter on a zone, you click the buy button immediately. You click it. You allow the trade to play. Two things will happen. Whenever you begin to look at trading like this, your psychology will be unstable. Two things will happen in this trade. If I'm playing this thing now, two things will happen. It either hits my stop loss or it hit my take profit. If it hits my stop loss, I am losing 25 pips. If it hits my take profit, good and fine. I am making 78 pips. Simple and straightforward. So since I now know that I am risking 25 pips, I will now adjust my stop loss to the kind of risk I can afford to take. Like for example, if I know that let's say for example I'm using one lot size on this trade now, and in as much as I'm using one lot size, if it is my stop loss, now the pips I'm going to lose is 25 pips, which is $25. And I take myself, I'll be like, guy, if I lose this $25, it will shake my body. I feel cry. What will I do? I will reduce that my lot size from one lot size to 0.5 lot size. Meaning that if the market goes against me, using that 0.5 lot size, if the market goes against me, what will I do? I will know that I am losing only but 12.5 pips, $12.5, and I think I'm okay with it. I will trade the thing. Now, look at the reason why many of you are greedy. I see some people, stacking up trades. You are entering a particular a trade, and you are entering, let's say you enter now, you are clicking, and somebody will open his trading account, and you are seeing like 4 or 5 trades running, or even some I normally see in the group, 6 trades, 8 trades running. If the market begins to go to the downside in a negative, how will you control your mind on those 6 trades that are running? It begins to, it begins to mess with your psychology. You'll be like, you close everything, and you might be surprised immediately you close everything, the market will reverse and go to your direction. Now look at the best way to trade. Let's say you enter here, the market is now going to the it will
Hello,
come
sir.
here,
Hello, can you hear
come
me?
down,
Can you hear me, sir?
yeah, pump
Can you
again,
hear me?
come here, touch down
Can you hear me,
again,
sir?
come here, come down again, go up
Can you
before
hear
it
me,
hits
sir?
this thing. Now, me as a trader, as a conservative and wise trader, look at what I will be doing. The market will go up, come down. Once it comes here to move to the upside again, I enter another trade. I'll bring my stop loss below it, and I'll still target that my zone again. The market will now go up again, come down again, come to this point. I'll enter again. I'll still target that my zone again. I'll bring my stop loss. I'll bring my stop loss below it again, like so. Now the market will go up again, come down again. It will come here. I'll enter again. This is the proper way to trade. You don't carry your risk over. Please stop carrying your risk over. Now, as the market is creating these higher highs and higher lows, remember, by that time I might have moved. Number one is that once the market come here, bounce out, and begin to go to this point. When it gets to this, I'll move all this stop loss from here immediately, and I'll bring it here. Meaning that there is no longer risk on the first trade. I am not carrying my risk from the first trade to the second trade. There is no longer risk on the first trade. I have protected myself on the first trade. Now, immediately the market moves from the second one and goes to it, I will bring my stop loss again below the second one. On the second trade, there is no risk again. There is no risk again. All the risk is gone. Like so, that is how to start trade. Not you will stay on one spot and you're clicking buy 8 positions running at the same time. You dey whine me. When the thing will now reverse, you say, forex trading doesn't work. Hey, trading is hard. This one, you are the one causing problem. This one now is based on, I'm just spotting the risk management a little bit. You are the one causing it for yourself, please. I think I've answered your question, sir. So this is the best way to trade.
Times, excuse me. Can you hear me?
I'm getting
Yeah, sometimes after the, like on 4 hours on a 1 hour time frame, it will go up and come down. That's where you are saying. Then you now adjust your stop loss. After it goes up again and come down, you adjust. Sometimes sometimes there will be a pullback that will wipe all those. That is, it will go down very well, then before coming up. By that time, it has taken you out.
okay. On that note, actually, what we are treating this night is called support and resistance, not general trading. Okay, I understand your question. There is something we call trend reversal. When the market is creating higher highs and higher lows, it simply means that the market is in an uptrend. There is a point the market will get to, it will reverse and begin to create lower highs and lower lows. It is called trend reversal. So I can't start explaining it here because I was supposed to treat support and resistance. That one is called trend reversal. So if you understand market structure very well and you use your trend line very well, use your support and resistance very well, you will know when a
Sir,
market is
can you hear me,
about.
sir? Can you hear me?
Let me even use
Can you hear me, sir?
this one. Now watch.
Sir, can you hear me?
Watch. Let's go back to 4 hours 1 day
Can you
time
hear me,
frame.
sir?
This market has been creating lower high and lower low and all that and all that. Now it get to this zone. It stopped. Why did it stop? Why did it stop? Because there is a strong support there. Now it didn't just stop. On 1 day time frame, you are seeing a bullish engulfing candle. On 1 day time frame, you are seeing a bullish engulfing candle. What? then what you need to do as a trader is to step down to lower, because you can't trade on a higher time frame. It's not done now. You only do your analysis on higher time frame. Like you come down to lower time frame to see what is happening in the market. Now let's go over to 4 hours. Let's see what is happening on 4 hours. Now on 4 hours, this is a trend reversal. The market has been creating lower high, lower low, lower high, lower low, lower high, lower low. Immediately the market comes into this support, it's created a double bottom. That is a trend reversal. The chart patterns are for trend reversal. There are many ways to identify trend reversal. Chart pattern is one of it. So immediately the market came. Okay, watch. Let me use this thing to it. The market has been creating lower high, lower low, lower high, lower low, lower high, lower low. The market has been creating lower. Oh, somebody saying I'm fast. I beg. Okay, let me slow down. Okay, now the market has been creating lower high. Now here the market created lower high. It created lower low. It should have come and create lower high somewhere around here to break down and create another lower low. But that didn't happen. That didn't happen. What did the market do? The market now created lower high, lower low, small lower high. Instead of breaking down, it created equal low, telling you that the trend is about to change. The trend is about to change. Now, immediately it created equal low. Next thing you are going to see is bounce to the upside. First take profit before it comes here.